Hello, all the CA and CMA final AFM or SFM students. Now, this is a complete formula panoramic view of the subject called as financial management. Whether you call AFM, whether you call SFM, concepts are anyway, both are same. So, I will be taking everything from the CA final point of view, which is equally applicable also for CMA. So, in this particular lecture, I am trying to cover all the important formulae that are applicable for your exam and where you need to keep an eye. Okay, let's go into that without any delay. Let's see. First one, we are going to see the Walters model first. Walters model, the formula is called as a perpetual dividend model where there is no growth. Okay, dividend impacts share price is the assumption of Walter model, and dividends are always constant. Dividends are always constant and it is perpetual. Normally, perpetuity, there is a formula. Present value of perpetual cash flows equal to cash flow per annum divided by required rate. That cash flow can be of two forms: paid cash flow, retained cash flow. Paid cash flow is the D by KE. Retained cash flow is R by KE into E minus D whole divided by KE. Both put together is the total value of a share. So P naught equal to D plus R by KE into E minus D whole divided by KE. One formula. Second one, Gordon's formula. P naught equal to D1 by KE minus G. This formula is predominantly and profoundly called as, this formula is called as constant dividend model. Okay, with growth. Constant dividend model with growth. This is a normal constant dividend. This is the constant dividend with growth, where P naught is the price per share today, present value of a share. D1 is the expected dividend. D1 not given in the question. D0 into 1 plus G. D0 into 1 plus G. G is called as a growth. Okay, it's a constant growth. So D1 means D0 into 1 plus G. If the question uses the word expected dividend, given information itself is D1. If the question given is to be paid dividend, given information is D1. If the question says that already paid dividend or just paid dividend or dividends paid over time, these all languages will suggest that the numerator is D0. We have to calculate D1. Okay. KE is the cost of equity. G is the growth. If G is not given in the question, you can calculate in two ways. Number one, P1 minus P0 whole divided by P0. When that can be used? If two prices are given. Prices are not given, but we have to calculate growth. Then G equal to B into R. G equal to B into R. B is the retention proportion. B is the retention proportion. When I say proportion, a point slide should come. Instead of saying 60%, say 0.6. Retention proportion into return on equity, not cost of equity. B into R, R represents return on equity. So G equal to B into R. It's a product of retention proportion and the required return on equity. Done. Next. On that, so many questions you are having in study mat. So solve them. I have solved all the study material questions in my notes. Okay, next. If a question is asked on two-stage dividend model, how to do? Two-stage dividend model questions will come in such a way where they will give you data relating to the earnings or data relating to the dividends or both details they will give. Okay, up to one period there will be a growth. After that there will be a different level of growth. In that case, in this particular situation, 1 to 5 years, there is one growth. After that, for the 5th year onwards, there is a different growth of 10%. There is a different growth of 10%. Here, 1 to 5, one growth will be there. From 5 onwards, another growth will be there. The calculation will be again made on the basis of Gordon's formula for the perpetual period. Okay, so I'm not going to discuss any problem now. If you have any doubt on this, share valuation already YouTube videos are there, you can listen to that. I'm not here to explain this question now. I'm here to tell that how and when this point called as the D1 by K minus G will be used. Okay, next, when D1 by K minus G can be used? Whenever in the question they asked a random pricing. They asked about what pricing here? Random pricing. Means what? Calculate price at the end of 4th year. If they ask that, immediately your mind should set. If at all they are asking some random pricing ki there is only one formula in entire AFM, that random, because random pricing means what? They are not asking to evaluate the price of a share. They are asking what will be the price at the end of 4th year. Like that, if the random pricing is given, then there is only one formula in entire AFM, that's Gordon's formula, P naught equal to D1 by K minus G. They asked P5. What you will do? If P naught equal to D1 by K minus G, P5 will be D6 by K minus G. That's all. So random pricing, this will be used. Clear? That's why in one question in examination, how they asked, they said, I wanted to sell the share for the first 3 years. For the first 3 years, they don't give price of the share. How to calculate? P1 equal to D2 by K minus G, P2 equal to D3 by K minus G, P4 or P3 equal to D4 by K minus G. Like that they have to calculate. Whenever question la random pricing is asked, immediately mind la fix. Koushik Mukhesh said, go to Gordon. That's all. Not Gordon directly, Gordon formula. Okay, next. Rights issue. Rights issue. Wait a minute. Okay. Rights issue and its impact on wealth. Rights issue and its impact on wealth. Okay. So, whenever rights question is tested, they will give you some data. What data they will give you? They will give you number of shares prior to rights. Number of shares prior to rights means before rights issue, how many shares are there? Okay, that we call as that number of shares before rights is called as N. Market price prior rights means what is the market price before rights issue? We call it M. M. Number of right shares you are giving in a ratio they will give. That's called as R, also called as a rights ratio or number of rights shares. S is the subscription price. Mn plus SR. I repeat, Mn plus SR divided by N plus R will give you theoretical post rights price per share. What is it? Theoretical post rights price per share. Okay. This formula ICA will represent in a different way. NP naught plus S divided by N plus N1. Nothing greater. Nothing greater. N is this N. I repeat, N number of shares before. This N number of shares before. P naught price before rights. M market price before rights. Both are same. So Mn can be written as NP naught. S subscription price. Yes, subscription value, because here Arthur they multiply, here already multiplied value they will give. This is called as rights subscription amount. N number of shares before rights. N plus N1 number of shares after. N number of shares. R number of right shares. So this and this are both are same. Okay, NP naught plus S divided by N plus N1. Either you write like that. No sir, this is much better for me. Then follow this. Study material this will be there. Accounting standard this will be there. That's why both I have written to avoid confusion of the student. So Mn plus SR divided by N plus R. Next one. Formula based theoretical cost of rights alone. Previous one, theoretical post rights price. Means after rights issue, what is the price of the share? Theoretical post rights. This is theoretical cost of rights alone. What is the cost of not the share? I want the value of the right, that hak. So you have given a right now. For that right, how much value is there? Formula. Post rights price. You calculate in a step 1 minus subscription price. This is one way. This is ICA followed value. Or there is a different formula. MPS pre-rights. MPS pre-rights and pre-rights market price. Post rights market price into rights ratio. This formula also can be used. ICA uses this. That's it. These are all the various formulas that are used in this particular first chapter called as share valuation. Because security valuation, two parts are there. Share valuation, bond valuation. This is share valuation. Okay. Next. See, along with these, I have some random formulas to discuss with you. Number 1. Whenever question like KE not given, but we want KE. check whether PE is given or not. If given, 1 by PE ratio becomes KE. Number 2, question wanted to calculate R, and return on equity, but it is not given in the question. Then how to do? Check whether book value per share is given or not. Sir, how to calculate book value per share? Book value per share is nothing but equity share capital plus reserves and surplus at the balance sheet value. At the balance, what is balance sheet? Balance sheet is a books of accounts. Value in the balance sheet is called as what value? Book value. That's why equity share capital in the balance sheet, reserves and surplus in the balance sheet, put together is called as a book value. This divided by number of shares will give you book value per share. That concept. Everyone understood the point? So, if book value per share is given, or book value is given, or indirectly equity reserves and surplus is given, but ROI is not given. Okay? Then how to calculate? There is a formula called as EPS equal to BVPS into ROE. BVPS into ROE. So, ROE will be EPS divided by BVPS. Okay? This is another formula that I wanted to tell you. Next, if you wanted to calculate pricing on a year-on-year basis, means what is the price next year, what is the price the next year, what is the price the next year, like that if the question comes, then use single period share valuation formula. Value of an asset is present value of future cash flows discounted required rate. What is the value of a share today? Present value of future cash flows. Present value means discount, so divided by 1 plus KE. Okay, only 1 year we are taking now, so power law 1 will be coming, even though it is not written insignificant. Okay, present value of an asset means the share will be equal to future cash flows. If I purchase a share today, I will be receiving dividend at the end of first year. After receiving the dividend, I will sell the share. Therefore, since you are receiving the dividend and selling the share, this price will be X dividend share price. The clarity that we need to maintain. So, Garden model, if you calculate a share price, the share price, whatever you get, is a X dividend share price. Understood the point clearly? Which share price? X dividend share price. It's not a cum dividend share price, because you received D1 and sold at P1. Means already the dividend is paid. It is a X dividend share which is sold at P1. Clarity. If really you found it new or understandable, please put a comment. It will reach more students here. Like you, so many people need the formula revision. It will reach so many people if you comment, like and share. So please share it to your friends. Like it if you really like the efforts that we are putting, and comment if you have any doubt, or if you are listening for the first time all these, please comment below. Okay, that's a small request from my side. It will reach more audience. Okay, and this is a non-monetized videos. All my YouTube videos are non-monetized. It's not for money. It will reach more number of people. Okay, like you, more number of students will get benefited out of it. Okay, let us go to the next one. I am going into the second area, bond valuation. Firstly, for bond valuation, first let us understand what is the pattern of a bond valuation. Generally in the questions in the exam, they will give a plain vanilla bond. Plain vanilla bond means nothing, no vanilla ice cream here. Plain vanilla bond means small coupons will come. Finally, a big scoop called as redemption will come. That's called as plain vanilla bond. It will be having a conical shape. Suddenly, a big scoop will come at the end. Okay, that's called as a plain vanilla bond. Nothing great. Okay, so whenever bond is a plain vanilla bond, characters of a plain vanilla bond are there is a life. There is a life. Every year one interest will come. Finally, finally redemption also will come. Start again. First, there will be a life. Column number 1 is year. Year 1 to 5, 1 to 6, 1 to 10, 1 to 20. Something you have to write. 1 to 12 like that. Second, column number 2 will be the cash flow. Coupons are the cash flows. Coupon is also called as the interest. Interest will come every year. Annuity cash flow, that's right. Third one is called as PV factor. A PV at the rate of YTM we have to calculate. What we have to calculate? YTM. We will see the formula later. Okay. Next, after that, PVCF will be the value of the bond. Fair value of the bond. Which value? Fair value of the bond. So in a bond statement, you will definitely find two things. Life 1 to some number of years. below last year, you will get the redemption back. So this is the bond valuation structure of a plain vanilla bond. If it is a zero coupon bond, also called as a deep discounting bond. In a deep discounting bond, life will be there, but coupons are not there. Only one. Invest today 1 rupee, future will take 10 rupee, that type. So there are only two cash flows, one inflow, one outflow. Therefore, how to calculate? Using this formula. PV equal to FE divided by 1 plus R whole power n. PV means how much we need to buy today. That we have to calculate. Future, like he said, I will give 25,000. How much we can buy today? 5667.65 is the maximum price you can pay today for getting 25,000 after how many years given here? 10 years. If your required return is 16%. Beyond this, I don't want to waste time. So remember, if it is a zero coupon or a deep discounting bond, pricing will be done as PV equal to FE divided by 1 plus R whole power n. Basic time value of money calculation. There is another kind of bond. This is called as a perpetual bond. Perpetual key, I told you the formula. Present value of perpetual cash flow equal to cash flow per annum divided by required rate. What is required rate? If it is shares na KE. Now we are in bonds chapter KD. So cash flow per annum. What is the cash flow you will get on a bond? Interest. Interest per annum divided by KD or YTM will be the value of the bond. That's it. Interest means coupon per annum divided by required rate. 16%. You got the answer. That's it. Everyone understood to here? So let's continue. If the bonds given are annual coupon bonds, means once in a year, then life will be as given in the question. Coupon will be as given. YTM is as given. However, if it is a semi-annual coupon bond, life will be doubled. Instead of writing 5 years, we will write 10 half-year periods. Next, coupon will be halved and YTM will be halved. So what is doubled? Life doubled, remaining are half. Quarterly, life will be multiplied by 4 because a year has 4 quarter division. And divided by 4 into 12 divided by 12 divided by 12. Completed. That's how the semi-annual has to be dealt with. YTM concept, very important. YTM uses the formula I into 1 minus T, interest into 1 minus T, tax, RV, means what? Redemption value, minus NP, net purchase price of net proceeds when you buy, divided by N, the life, whole divided by RV plus NP divided by 2, RV plus NP divided by 2, redemption value plus net purchase price divided by 2. This is called as an average price. This is called as average price because we will buy at NP, we will sell at RV. Sell means what? We will give money to the company and take a debenture. Okay. Purchase of debenture by giving money. 5 years after, sell the debenture and get the money. So redemption is also called as a sale. Net proceeds is also called as a purchase. Selling price plus purchasing price divided by 2 is the average price. So denominator average. Okay. RV minus NP, selling price minus purchase price is the capital gain. Capital gain divided by N means capital gain per annum because we are adding it with interest per annum. So I into 1 minus T plus RV minus NP by N whole divided by RV plus NP by 2. The only one observation that you need to make is RV should be considered after tax. After tax means what? If tax 30% is given, RV into 1 minus T, wrong. I'm not telling that. See, like this you should do. I purchased at 100. Okay. I purchased at 100. Or I can tell this way. RV 100, NP 80, 20 is the capital gain, 30% is the tax, capital gain tax. Let us say 20% is the capital gain tax, 4 rupee. Don't write 16. We are not doing income tax. 4 rupees in this 100 I will not receive because I received 100, but in the form of tax I have to pay 4 rupee. Na? So net RV will be 100 minus tax paid, which will become 96. That you need to observe properly. I'm not going to repeat this one more time. You go back and understand what I said. Next. Very important thing in the examination with regard to bonds. Whenever a bond valuation question comes in examination, whenever YTM is calculated, the YTM whatever you calculated will become approximate. It becomes approximate. We have to calculate accurate YTM. How? Take the info. You got 9.3 You got 9.3 or not? You do one thing. Take 1% lower than that. Take 8%. Take 1% higher than that. 9.38 means you can take 10. I have taken randomly 11. You can also take 10. No problem. Okay. No need to mug up now. 11 you should take. Koushik Mukhesh has taken 11. Institute will take differently. They will give marks for all of our answers because everyone can take any wise assumption. See, answer came as 9.3. This is approximate. This is approximate because numerator, the denominator, you have taken average price. Actually, you did not purchase at average. You purchased at 10p, but divided by average, answer also will become an average only, not an accurate one. We need to turn it into accurate. 9.3 is an average or 9.3 is an approximate. It can be either higher than that or lower than that. Take one rate higher. Okay, take one rate higher. 10.3. 10.3 can't be taken. Take 11. Okay, next 1% lower. 8.3. 8.3 can't be taken. Take 8. That's how I have taken 8 and 11. So 11, 8. PV at the rate of 11. Why we are applying PV? Because 9.3 is the YTM rate, also called as a PV factor rate. This is not accurate. Okay, so 11% ki price of the bond is 82. Whenever you are checking this price, you should compare it with the NP. Okay, not with RV comparison. NP, purchase price. Now the price now we have to compare. So we want 90, we got 82.5. We got 90, we got 93.26 when it is 8. Always remember, discounting factor increases, price of the bond will decrease. Discounting factor decreases, price of the bond will increase. This is how inverse relation will happen. Okay, so therefore, at 8% price is 93, at 11% price is 82. So we want 90, it will be definitely in between 8 and 11. So we at 11% price is this much, 8% price is this much. For 3% change, if the price of the bond changes by this much, for 7.42, how much it will change? 8.92, 8.92 on both the sides if you calculate. So 9.3 is approximate, 8.92 is accurate. Very, very important. And next thing, you are taking 6.3 here. Okay, why? See, sale price, purchase price, capital gain, tax on capital gain, net redemption value is 105 minus 1.5, 103.5. Same you should also take in the below table. Okay, next. Yeah. Next one, duration. Duration, how to do? 6 columns you have to take. How many? 6 columns. Year, cash flow, PV at the rate, PVCF are the same. Last, another 2 columns have to be added. Proportion means what? This divided by this. This divided by this. This divided by this. All these divisions we should do. Proportions will come. Okay. This proportion into year. 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 This is the duration. That's why this duration is called as a weighted average duration. Weights are proportions. Okay. More than this original lecture only. If you want, go and listen to the revision lectures that I have already uploaded. Next. Duration we calculated. Now we are going to calculate volatility. What we are going to calculate here? Volatility of a stock. Duration we calculated, that divided by 1 plus YTM. That divided by 1 plus YTM is called as what? Volatility. Volatility is expressed in a percentage. 2%. What do you mean by that? If YTM changes by 1%, changes are the up or down anyway, either addition or deletion. If YTM changes by 1%, price of the bond changes by 2% inversely. Because YTM is a discounting factor. Now, just now what I said, discounting increases, price reduces. Discounting increases, price increases. So, for a 1% change in YTM, bond price inversely changes by, in this question, 3.63%. Formula derivation, regular classes, not now. Next. Forward rates. What rates here? Forward rates. What is a forward rate concept? Forward rate concept is a concept where YTM or the discounting factor is there that changes every year. How to calculate? They will give you the following data. They will give you what? Following data. Okay. They will give the data relating to face value. Let me check. Take this question. This will be more easier for you. They will give you data relating to face value. Okay. Or fair value of the bond. What value? Fair value of the bond now they will give. CF1, cash flow 1. And the next year interest rate they will give. Cash flow 2 they will give. We have to calculate the forward rate. Forward rate means a YTM rate for a particular year. Generally YTM, whatever we calculate, we will think that throughout the life of the bond, same YTM will be there. But RBI will change interest rates, immediately expectation in the market will change, but we don't assume that. Normally we will do. If we assume that there is a change in YTM year on year basis, how to do? Like this you should do. This is a question taken from interest rate swaps. So do here itself. FB equal to fair value. Now equal to cash flow 1 divided by 1 plus R1 plus cash flow 2 divided by 1 plus R1 into 1 plus R2. Okay. First cash flow 1, 10% he has given in the question. 1 lakh into 10%, 10,000 divided by R1. Already calculated R1, 1.093. 1 plus R1, 1 plus 0.093 became 1.093. Cash flow 2 means redemption I will get 1 lakh plus 30-year cash flow of interest 10,000 I will get totally 1 lakh 10,000 divided by R1 already we got. R2 is the missing figure. It is 12.6. 3 years bond directly. F equal to CF1 divided by 1 plus R1, CF2 divided by 1 plus R1 into 1 plus R2, CF3 divided by 1 plus R1 into 1 plus R2 into 1 plus R3. 1 plus R1, 1 plus R2 we already know here. Only 1 plus R3 will become the missing figure. E 12.6 becomes 12.6 here. Okay. If you didn't understand what I said, I just trying to revise the formula fastly. If you do not understand, go to the original video or go back to the same video and listen again. Next. If zero coupon bond is given in the question and they ask you to calculate forward rate. Okay, asked you to calculate forward rate. F1 means what? Forward rate for the year 1 is the YTM rate itself. F2, F3 changes. F2 equal to 1 plus R2 rate given for the year 2 whole square divided by 1 plus R1 minus 1. So what is F3? F3 equal to 1 plus R cube divided by 1 plus R1 into 1 plus R2 minus 1. Mug up the formula as it is. No, sir, I wanted to know the logic. Derivation, why it came, how it came, what we need to understand, why they have given like this, why zero coupon bond, if not zero coupon bond, what will happen? Every single detail, regular classes it is there. In one of the revision lectures recently also I uploaded that. Next, very important, convertible bonds. Convertible bonds, there are 6 formulae. 4 I have written here, 2 I will show you. 6, stock value of the bond. If bond is converted into share, what will be the value? One bond will be converted into some number of shares. Okay. So on conversion, what is the value? That share price. So number of shares into market price per share is the stock value of the bond. This is also called as conversion value. What is it? Conversion value. Percentage of downside risk. What is percentage of downside risk? Convertible bond, 2 components are there. Share component, bond component. Okay. If share becomes 0 also, still it is a bond or not? So still it retains what value? Bond basic value it will retain. So market value of market value of convertible bond minus straight bond value. What value? Straight bond value. Straight bond value means a normal bond, plain vanilla coupon bond divided by CBV into 100. CBV into 100. Okay. Institute study material, they will use this minus this. Instead of using this minus this, they will use alternatively. Understood the point clearly here? Next, conversion premium. If you buy only bond, convertible bond, okay, then I have to pay 365 rupees, 265 rupees. Okay, why you are buying a convertible bond? To convert that into share. Directly also you can buy a share or not. Today, if you buy the share directly, you should spend 240 rupees. Why 240? Why 240? It is only 12 rupees now. You are comparing that with a convertible bond which converts into 20 shares. Therefore, shares also you should tell in 20 shares terms. So, one convertible bond, if you wanted to pay 265, you need to pay. But if you buy the shares directly, you have to pay 240. So, convertible bond value minus conversion value, 25 is the conversion premium. Conversion parity price. Per bond, how much extra you are paying? Convertible bond value divided by number of shares per bond. 13.25 rupees I am paying as a each bond I am paying 13.25 because each bond is getting converted into 20 shares. Okay. So on that point of view, if you see how much you are paying, 13.25 rupees you are paying for each share to get converted and buying as a convertible bond. So in simple, there are 4 important formula. Stock value of a bond also called as a conversion value, MPS into number of shares per bond. Okay. Next, percentage of downside risk. Market value of convertible bond minus straight bond value divided by convertible bond value. Next, conversion premium, convertible bond value minus conversion value. Conversion parity price means convertible bond value divided by number of shares per bond. Next, remaining any new thing now, I will explain. Conversion premium, ratio of conversion premium. Ratio of conversion premium means it is conversion premium per share. Conversion premium per share divided by MPS. Remember the formula. Favorable income differential. What is this? If I put it as a bond, I would have got interest of 85 rupees on that. Since I am converting it into a share, okay, how many shares are there in this question? This is a new question. 30 shares are there. Means income per share is 2.833. 2.833. I repeat one more time. One convertible bond is face value 1000. 8.5% interest will be paid. And on one convertible bond, how much dividend, how much interest I will get? 85 rupees. But you can't compare directly with share because this is having 30 shares inside. So per share, how much dividend you are paying? 2.833. Interest you will be getting, income you will be getting on each share inside it. Okay. If you put it as a, convert it as a share, you will get a dividend of 1 rupee. Becoming a bond, convertible bond, how much a favorable extra income you are getting? 1.833. So, favorable income differential formula is income on convertible bond. Which one? Income from convertible bond minus, divided by number of shares minus income from share independently will become the in a favorable income differential. That's it. Next one, bond immunization. Bond immunization. Whenever bond immunization is given, there is a formula. Okay, there is a formula. There are 3 steps. Number 1, when our question is having full data of a bond, price, life, coupon, YTM, all details are given in the question, and then they ask you to calculate convexity. Okay, then they ask you to calculate convexity. Immunization don't have any formula. It's a concept only. So if you want revision lecture, I have uploaded full bond valuation. You can go there and see. So steps in convexity. So what doubt will come? What is this convexity? I am not going to explain. Revision video I explained. Now formula. There are popularly 3 steps in convexity. Full data given. What given? Full data given. But for 1 year data given. And what is the ITM? What is the interest? What is the price? All these details are given. Then in that case, 3 steps we have to do convexity. Number 1, cumulative discounted cash flows. Cumulative discounted cash flow means what? Aggregate of T into T plus 1 into discounted cash flow. So second part is discounted cash flow. See, this is a discounted cash flow. Okay. Into T plus 1 into T into T plus T means time. 1 into 1 plus 1, 2. 2 into 2 plus 2. 2 plus 1, 6. Like that calculate. T into T plus 1 into DCF. Multiply both of them. These two multiply. This you multiply. This you multiply. Aggregate all of them. This is the first answer. Step 1. Step 2. Step 1 answer into 1 by 1000 into 1 by YTM whole square. So just step 1 divided by price into 1 plus y whole square. Price into 1 plus y whole square. You will get one answer now. This is the degree of convexity. Degree of convexity. Let us now adjust in this formula. They will give you in the question how much change is there in the YTM. Okay. V, volatility, already calculated in the question 3.791 into change in YTM 4%, write down 0.04 plus half into convexity means average convexity divided by 2 into change in YTM square minus 0.04 square means how much? 0.04 square. So minus will be insignificant. So you will get the answer 16.71. What do you mean 16.71? What do you mean 16.71? If YTM changes by 4%, price of the bond changes by 16.71%. Okay. So this is the point. Next, very, very important here. 4 marks or MCQ also can come on this. If convexity question is tested in exam, but nowhere they have given the details of life, everything. They have given only prices, previous price, the next price, like that they have given. In that case, this formula we have to use. P positive plus P negative minus 2 present price. 2 into present price. divided by 2 into present price into YTM, change in YTM square. Sir, I didn't understand. Sorry, this is not the time to learn the concept. See, we assume that price can go to 98.782, come down to 98.669, can be either, as now it is trading at 98.722. Using these three data, you can calculate convexity. How? P positive plus P negative. P positive plus P negative. Two prices we have taken a minus 2 into P naught in order to match with the first two components. 2 into P naught divided by 2 into P naught into YTM. I told you, don't write directly percentage, 0 point like that you have to write. YTM. Change in YTM is 10 basis points. 100 basis points make 1%. 10 basis points means 0.01 whole square. We got 35.46%. What do you mean 35.46%? This is like this. This is like this. 13.46%. Next, money market instruments. If you wanted to calculate yield per annum on money market instrument, RV minus NP divided by NP into 365 by N. This is a calculation of issue price. Okay, yield equal to, they will give the yield, you will calculate NP. NP is the issue price, net proceeds. RV minus NP divided by NP into 365 by N into 100. Months like given a 12 by N into 100. Same. Duration can also be calculated using this formula. Just have a look. Pause the video, have a look. That's it. Nothing great in this. This is all the formulas relating to bond valuation. Next one. I will be going into the next area called as business valuation, also called as corporate valuation. Next area is business valuation. So, basic share valuation, two-stage model already we completed, Garden type. Economic value added, market value added, and free cash flows are the three main concepts that we need to concentrate. Okay. So, normal calculations I told, D1 by K minus C kind of calculation. So, this is strictly in lines with D1 by K minus C model. Whenever you wanted to calculate a payout ratio not given in the question, DPS by EPS into 100, another formula. Next, whenever you have to calculate KE with the RF figures, then K equal to RF plus beta into RM minus RF. Next, whenever KE has to be calculated without growth, instead of calculating D1 by P naught, you can calculate D by P directly without a growth. Next. Yeah. There are two important ratios, fixed interest and dividend coverage ratio. Fixed interest and dividend coverage ratio. Logically speaking, interest coverage ratio, okay, interest coverage ratio. Fixed interest and dividend coverage ratio means interest and dividend should be covered. Interest and dividend should be covered. See, interest, dividend will be paid out of EAT, okay. Dividend will be paid to two people, okay. Number one is the preference dividend and number two is the interest. See, I will repeat one more time. When I say dividend coverage here, I am talking about preference dividend, not equity dividend. Okay. See, EBIT belongs to whom? Debenture holders. No. Debenture holders won't take entire EBIT, they will take only interest part. Therefore, for debenture holders, interest. Okay. Preference shareholders will take preference dividend out of what? Out of earnings after tax. Out of earnings after tax. So, earnings after tax plus interest divided by preference dividend plus interest. This is the answer. So, answer I am not going to discuss. Whenever question comes on fixed interest and dividend coverage ratio, whenever we say coverage ratio, source will be there now from where you will pay. That should come on numerator because the answer will be in number of times. So, numerator should be always higher, denominator should be always lower. So, if numerator sometimes is lower, now that's a worst company. So, EAT means the earnings after tax. From that we will pay preference dividend. Interest is paid to debenture interest, that's all, because EBIT is not belonging to them now completely. So, this is the point here. Capital gearing ratio. This is a same way of calculating debt equity ratio. Okay. See, debt equity ratio. Debt means what here? Preference also is a debt. So, preference share capital plus debentures, debt by equity. Equity share capital plus is the answer completed. That's it. Next. Turnover ratio, asset turnover ratio, turnover by total assets. Asset turnover ratio means turnover by total assets. Gross margin means the profit on sales. Profit on sales. First part I told na, G equal to B into R. They will give you BVPS. BVPS means what? BVP, book value per share, means book value by number of shares. What is book value? Equity share capital plus reserves and surplus at balance sheet value. Equity share capital plus reserves and surplus at balance sheet value. Return on equity. That's why book value is also called as equity. Book value is also called as equity. Book value per share also called as equity per share, not equity share per share. Equity per share. So return on equity. Growth is B into R, retention proportion into return on equity. Return on equity not given. Return on equity means what? Return by equity. Return on capital, return by capital. Return on investment, return by investment. Return on equity, return by equity. So return by equity. Return means what? Equity means what? Equity share capital plus reserves and surplus. Equity shareholders want which return? E80 return. So E80 by this one. Next. Pause the video and see if you want. Next. Next one is EVA formula. EVA is nothing but EB80 into 1 minus T, also called as NOPAT, means net operating profit after tax minus KO into capital employed, minus KO into capital employed. So the main formula that you have to remember is EB80 into 1 minus T minus KO into capital employed. Listen carefully, some observations here. EB80 they will not give in the question. They will give net profit, reverse calculations you have to do. That you practice properly. Next, tax don't forget. If you forget tax, na concept is wrong. Next, KO will be calculated through KE, KD, WE, WD. So WD, KD plus WE, KE. Okay. KD means YTM, you know how to calculate. KE means you know how to calculate. KE equal to D1 by P0 plus G. Generally, they will give in the question. If they don't give, also you should think na, at that time, you should not tell Koushik Mukhesh did not teach. That's a basic. We already taught in Inter and also taught in CA final share valuation, first chapter. Okay, so KO into capital employed. Very, very important. Capital employed represent, okay, capital employed means both debt as well as equity employed in our business. Therefore, any investments made in other companies should not come into this capital employed. Keep that in mind. Okay, for the different. Sometimes through financial leverage you have to calculate. Through what? Financial leverage we have to calculate. Financial leverage means what? EBIT divided by EBT. Okay, EBIT divided by EBT or EBIT divided by EBIT minus interest. Like this we have to calculate. Okay, then EBIT will come, remaining things will come in place automatically. Okay, next. Always, a capital employed may not be calculated through liability side. Capital employed can also become sometimes assets side. Okay, so generally what we will do, capital employed means what? Debt plus equity, liabilities. But sometimes they don't give that data. Then total all the assets, including intangible assets, including working capital, including plant property and every asset you add, minus outside liabilities. Okay, minus outside liability, that will become capital employed. See, in this question, outside liability not there. 140 lakhs is the capital employed, asset side of calculation. That's it here. Remaining nothing great you can do normally. Market value addition means value before and value after. You need to just calculate and confirm the market value addition that was made on the share. Okay. Next, what is the next concept? Free cash flow. Very, very important. For exam, Pakka, this time question will be there. So understand the formulas clearly. I don't want to waste your time. I will just fastly complete. See, question is asked on free cash flow for firm. Question is asked on free cash flow for firm. And the information, data given to you is PAT. How to calculate? PAT plus non-cash flow depreciation, interest into 1 minus T you add back, plus or minus capex, sale of asset plus capex, purchase of asset minus capex, plus or minus working capital change. Okay, this will be plus if working capital is decreased. It will be minus if working capital increase. Okay, so reverse light will happen. So PAT plus depreciation plus interest. Why interest is added? It's cash flow only, not non-cash flow like every concept regular batch I told you very clearly. Regular and EOB, both the batches I told the logic why we will do. This is not the time to learn the concept, just see the formula. PAT plus depreciation plus I into 1 minus T plus capex plus or minus capex plus or minus change in working capital. Through EBIT into 1 minus T. Okay. tax portion remove, minus plus depreciation, interest will not come because we have taken already before interest only, plus or minus capital, plus or minus change in working capital. No sir, I wanted to calculate FCFE. So PAT plus depreciation plus or minus capex plus or minus change in working capital. Along with that, since you are calculating only for equity, debt also should not be considered in valuation. So plus or minus net borrowings. What do you mean plus or minus? Borrowings made na plus, borrowing paid na minus. EBIT into 1 minus T plus depreciation. Now interest also should be deducted because they are also outsiders in this formula. Plus or minus capex, everything is same. So formula, pause and observe all the formula, then do the question. That's it, yeah, nothing great. These are all the things. Next, with regard to next chapter, I will start with mergers and acquisitions. Mergers and acquisition. See, mergers and acquisition, the most important thing is a swap ratio. First one, what ratio? Swap ratio. Swap ratio means NAV per share divided by NAV per share of selling company divided by NAV per share of purchasing company. But if the banks are in NPO, banks are in non-performing orders, or it is in a non-performing asset, then reverse calculations will make in swap ratio. Okay, what ratio? Reverse calculations will make. Means these all calculations apply if the company is a solvent company. If the company is an insolvent company, calculations will be reversed. NAV of purchasing by NAV of selling will come. Okay na? Why? I am purchasing a debt company. You should pay me, not I should pay you. Understood or not? After you becoming solvent, you should pay me. That's why all reverse calculations will happen. So normally NAV model of what to do? NAV per share. Don't calculate total NAV. NAV per share of selling company by purchasing company. EPS basis. EPS of selling company by EPS of purchasing. MPS of selling company by MPS of purchasing. That's it. No, sir, I wanted to calculate EPS after merger. How to calculate? EPS post merger equal to earnings post merger divided by number of shares post merger. Earnings post merger divided by number of shares. Earnings post merger means add the earnings of both the companies. Okay, add the number of shares of both the company, but when you are adding this, you should add for the selling company after exchange ratio is applied. After exchange ratio means selling company has 10,000 shares before, don't add 10,000. 10,000 into exchange ratio, 3 by 4 1 by 4 or 5 something. Next, undiluted earnings. Whenever question comes, EPS should not decline after merger, MPS should not decline after merger. What should not decline? That model you have to calculate swap ratio. In this question, okay, in this question, earnings should not decline. Therefore, take the swap ratio on the base of earnings. That's it. Next, market value of merged firm. How to calculate MPS post merger? Very important formula here. How to calculate MPS post merger? EPS post merger into PE ratio post merger. Remember this. Every question in mergers chapter we will do this formula. MPS post merger equal to EPS post merger into PE ratio post merger. Next, market value of merged firm. MPS you calculate into total number of shares after merger. You will get total market value. Next, whenever question is asked on free float means other than promoters party is a free float. Nothing great here in this, all this formula. There is no great thing that is going to happen in this, so I can't tell that these are most important. These are all procedural chapters, nothing great. Synergy, I can tell you the proforma, the format, how to do synergy questions. Standard format for synergy. First, apply this standard format. Any question in synergy will solve in exam. Market value of purchasing company. Synergy means what? Two companies merge, 1 plus 1 is more than 2. That's logic. Market value of purchasing company, market value of selling company, total market value before merger. Now you had some merger, because of that synergy will come. That synergy is perpetual value you should take here. If they give 1 year ki 1 lakh, you should calculate 1 lakh divided by KE. You will get full value, perpetual, that value you should add. Market value of merged firm. In this market value, on that basis, selling company will be given share, because of selling company also some value addition happened. So market value of merged firm. Number of shares post merger. So price per share will come now. At that price, we will issue shares to selling company. Cost of merger and cost to purchasing company. Purchase consideration. Price per share, this one. Number of shares to selling company. Exchange ratio. This will be the one. Now, let us say 100 rupees came. 100 rupees is what? Payment made by purchasing company to selling company. Okay. Entire 100 is a cost to this purchasing company. Yeah? No. Selling company is not a zero company. Na? Without merger, it is already having 80 rupees value. That 20 becomes the net cost of merger. Okay. NPV, net cost synergic gains. I got 70 synergic gain. In that 20 already I paid to selling company. Now, this 50 will be called as NPV of a merger. Problems you have to solve. That's it. Yeah, these are the main formula that you need to understand. Mergers equations chapter, you have to practice. Our question book totally 35 questions I have given. All 30 are past exam RTP, MTP questions included. Do that. After that, you do whatever you want. But first, don't fail to do that. Next one, we are coming into Forex. Okay, so let us start with the Forex. What is this formula revision? So formula revision for the Forex is direct quote number of units of home currency for every 1 unit of foreign currency. Home currency by foreign currency it will come. Indirect quote foreign currency by home currency will come. Okay, dollar by rupee means number of dollars per rupee. It's an indirect quote. Okay, rupee by dollar, number of rupees per dollar, that will become indirect. Number of units of home currency per 1 unit of foreign currency. So technically speaking, the home currency by foreign currency by home currency. Per unit means it's in a denominator. Whatever is in per unit, that's most important for us to understand. Rupee is in per unit, an indirect quote on rupee. Rupee is in numerator, that will be direct quote on that particular currency. Sorry, anyway. Let us directly go into direct quote can be written as 1 by indirect quote. Indirect quote can be written as 1 by direct quote, vice versa. Okay, next. Let us see if there are any typical formulas that we need to discuss. Conversion, how to do all those, don't ask me here. Okay, so let's go to PPPT. 1 plus ID divided by 1 plus IF equal to F by S. 1 plus ID. ID represents inflation of domestic currency, inflation of foreign. Now question will come. In exam, how to identify which is a domestic or which is a foreign? You should understand the quotation given. Go by quotation. For example, they given $1 equal to rupees 70. Example, $1 equal. So let us say they have given $1 equal to rupees 70. Now, how to understand? Let us say this is a given quotation, this is a direct quotation. Assume that in a direct quotation, what will happen? Number of units of home currency for 1 unit of foreign currency. So this is the foreign currency. A dollar is a foreign currency. This is, or sometimes 1 rupee equal to N's 2.1 they will give. In this case, what will happen? Assume this also as a direct quote. Number of units of home currency for 1 unit of foreign currency. Though rupee is not a foreign currency for us, for formula calculation, rupee will be treated as a foreign currency. Understood? That's the observation that we need to keep in mind. Next. After that, great formulas are not there. It is all about how you understand the concept only. Actually, so there are no formula in this, only concept related things only will come. Next, options and futures also. Futures, there are so many formulae. Okay, let me go to futures directly. In futures chapter, there are some formulae that you can keep in mind. See, fair futures pricing. Whenever you wanted to price the futures, it depends on what you are valuing. Stocks are commodities. No, sir, stocks. With the dividend, without dividend. Sir, without dividend. Then F equal to S into E power TRF. F futures value is spot into exponential value of T into RF. It's not TR into F. T into RF. RF is the rate. T means time. Whenever time is given, you should take it in years format. Means they give you 3 months. 3 into 10% or 0.1 you should not. Convert into years, 3 by 12. Like that you have to do. Okay. So F equal to S into E power T into RF. Like that we have to calculate. Okay. So this is without dividend, with no dividend. Next, with the dividend. With the dividend again two types. Rupee terms, percentage terms. If they give dividend in rupee terms, F equal to spot minus dividend. Spot minus dividend. When you take the dividend, you should not take dividend, you should take present value of dividend. Means dividend will be given discounted by E power TRF. Okay. So into E power TRF. Why spot is a present value? Dividend is declared after 2 months. You can't reduce a 2 months value with today's value. Time value of money will not agree. Therefore, convert that into PVD. That's why whenever I write D represents dividend income only. Correct. But present value of dividend. Next. Percentage they have given. Don't reduce anywhere from the percentage because S is a number. Okay. E power T into RF is a percentage. From that you reduce. That's it. Like that we will do the calculation. Okay. Next. Sir, if it is a commodity, what will happen? If it is a commodity, you have to calculate F as S plus CTC. S plus CTC. S means spot price plus cost to carry. Cost to carry. How to calculate cost to carry? S into E power TRF minus 1. Or you can also calculate 1 minus E power TRF. Anything you can do. You will get one value. That one you need to take here. Are you understanding? See, S into E power TRF minus 1. S E power T into RF minus 1. Okay, you got 1, 2, 2, 4. What is this 1, 2, 2? 1, 2, 2, 4 is the 1, 2. 1, 2, 2, 4 is the value that you will get for CTC. S already given 30,000. Plus you need to add this. You will get the value. Next. Convenience yield is there. Convenience yield. I am not going to explain what is convenience yield. 1 hour I have taken in revision class only. So I will just tell the formula. F equal to S plus CTC minus CY. S plus CTC you already know na. Convenience yield is always a missing figure they will give in the question. They will give futures, they will give spot, you have to calculate this. Missing figure will be CY. So there is no formula for convenience yield. That's what I wanted to tell. What is convenience? If they give convenience yield, CTC becomes missing figure. If they give everything, F become missing figure. CY don't have any formula. CY is a missing figure in all questions. If they give, take it. If they don't give, missing figure is CY. Okay. Next. Remaining formulas are not there. Those are all concepts. Next. If it comes to options. In options chapter, not formula, just a concept again. If SP is less than AP, if SP is less than AP, first let us see for the call. If SP greater than AP, if SP greater than AP, lapse for a call holder. SP equal to AP indifferent, SP less than AP exercise. Concept is very clear. SP is a price in my hand. AP is a price moving in the market which is not in my hand. So what is in my hand? I need to do and control on that. See, SP, my price is higher than actual price. Means what? SP is a price with me. AP is a price in the market. Call holder will buy the share. Call holder will buy the share. So always I should say buying price should be lower. Na? So SP should be lower, but here it is higher. Therefore we will lapse it. Everyone understood? So if call holder is there, if you are a call holder, you will buy the share. You will always try to buy at a lower price. What is the price in your control? SP. So SP should be lower to exercise. So SP less than AP, exercise. Reverse happen for a put holder. But that's not a formula, that's only a concept. Let us go to formula mainly. Now, first, break-even concept in options. Okay, break-even concept in options. For calls, break-even formula is SP plus P, strike price plus premium. In case of put holder, SP minus P, put option. Next. After that, put call parity equation will be there. Yes. Put call parity equation is VC, value of call, PV of SP, present value of strike price, equal to VP, value of a put plus value of a share, present value of a share. VC plus PV of SP equal to VP plus VS. Over. That is another formula. After that, whenever there is a dividend given in options, formula will change. I forgot actually. I'm very sorry. There are four formulas, the two formulas that we need to remember. I think I skipped it by mistake. Yeah, very important. These two are important for exam. Minimum value of a call, also called as the value of a call. Value of a call equal to spot minus present value of strike price. Spot minus present value of strike price. Put option reverse. Present value of strike price minus spot. Spot minus present value of strike price. If dividend is there, what will happen? Instead of spot minus present value of strike price, what they will do is they will take spot minus present value of dividend minus present value of strike price. Whenever spot comes from spot, reduce the dividend, like what we have done in futures. So spot present value of strike price minus spot is there now, minus PVD you have to take. Understood the point clearly? So spot minus PVD, spot minus PVD, minus PV of SP, PV of SP here. Understood? That's how we need to do. Next one, the bigger one, the main biggie in this particular area is the Black-Scholes model. What is it? Black-Scholes model is there. By the way, there is a binomial model, risk neutralization model ki one formula. Probability of highest price, probability of upward share price or highest price. E power TRF, if given in exponential value, if given in normal value, take normally. Minus D, downward actual price by spot price. U, upward actual price by spot price. Okay, E power TRF, this is probability of highest actual price. Derivation also given, you can see it later. Black-Scholes model, step by step we need to calculate. See, first ln of S by SP, ln of S by SP. S is spot, SP is the strike price, spot price by strike price, natural log value. They will give in the question natural logs. Next, D1, ln of S by SP plus standard deviation square. This is also called as variance. If in the question variance directly came, don't again square it. So standard deviation square by 2 means which is half the standard deviation, 0.5. Plus RF into T. T always how to write? If it is given in months, 3 by 12. Days, 182 by 365. Like that you have to take. So ln of S by SP, first step value, plus sigma square by 2, half the standard deviation, into plus RF. Okay, divided by sigma into root T. Sigma into root T. Sigma into root T. T how to write? You have to write in the year format. Okay, that's it. Step 3, D2. How to calculate D2? D1 calculated and now D2. D2 means what? D1 first value minus denominator of D1. Okay, mug up the formula literally. Black-Scholes will come in this attempt. I already told you. NT of D1, normal table value of D1. Okay, so you got 0.043. You got D1 na 0.3728. Go to standard normal distribution table. Find the value for this. Okay. So many students, not one student, 100 like 80, 90 students are not knowing how to see standard normal distribution. That's why I'm coming up with a 2 minutes video as to how to see the standard normal chart. Okay. So no worry. I'm there now. No worry. 1 minute before exam also, if you see, you can understand what I am saying. So D2 is D1 minus denominator of D1. NT-D1 means normal table value. NT-D2 means normal table value of D2. D2 means this value. Next, ND1, 0.5 plus or minus NT-D1. From here, everything is easy again. NT-D1 already came now, 0.5 plus or minus. Sir, plus or minus, if D1, NT-D1 value is a negative, then minus. Plus or plus. Next, E power minus TRF. Next, just now we calculated na. Normally, what we will do, spot minus present value of strike price is the formula for value of a call. Na? So here spot into ND1 will get added. Minus present value of strike price, na, SP into 1 plus SP into E power minus TRF, which is a discounting, means 1 by into NTD2. That's how we will calculate. Okay. So remember the first 9 steps. I'm slowly going down. Pause the video whenever required. Apply the 9 steps. That's all. You will get the value of a call. This call value understood. Normally call value is spot price minus present value of strike price. Spot into ND1 you add here. Add means don't add. Add means additional point is coming. Multiply. Okay. PV of SP means what? Generally what you will do? SP into E power minus TRF. Here also do the same. Just multiply again n of d2. N of d2. You calculate n of d2. N of d2 means 0.5 plus or minus nt d2. Okay, that's it. Remaining everything is okay. So now mutual funds la nothing great. Yeah, mutual fund la NAV calculation, net assets value divided by number of units. Return calculation will be done as return. I will get dividend return D1. Always remember D1 means dividend per unit. D1 plus CG1 capital gain per unit plus NAV1 minus NAV0 whole divided by NAV0 into 100. If it is a dividend growth model, listen to my words clearly. If it is a dividend growth model, dividend won't be given in cash. Capital gain won't be distributed in cash. Therefore, units will increase. So whenever you calculate return of a dividend growth model, in that case, you should not take D1 plus CG1. NAV1 minus NAV0 whole divided by NAV0. However, NAV1 into, okay, NAV1 into number of units at end plus NAV0 into number of units at closure at the beginning. So, in simple concept, normally return of a mutual fund is D1 plus CG1 plus NAV1 minus NAV0 whole divided by NAV0 into 100 with the return calculation. However, in the question, if they give you dividend per unit, if they give you dividend growth model, these two will not come. For that only compensatingly number of units will increase. So N1 into number of units at the end, number of units N0 into number of units at 0 whole divided by N0 into number of units at 0. Like this you need to do. Okay. Reverse calculation problems are there. Three questions are there in my question bank. Reverse calculation. Do them properly. They will come in exam. Reverse calculation they will ask. Direct calculation, if you do not, reverse calculation is just your practical illustration. Concept, a new thing is there, I will tell. That's not a concept. That's only you need to understand in a reverse way. Okay. Next. The main biggie in the entire portion, portfolio management. Let us see the portfolio chapter formula revision. Okay. See. First one. KE. D1 plus P1 minus P0 whole divided by P0 into 100. Okay. This is one way. This is for 1 year KE calculation. Sir, this is not a new formula. For your kind information, I told you one formula. P0 equal to D1 plus P1 divided by 1 plus KE in the beginning of the video. That reversal is this formula. Next, return angle of calculating K. K equal to D1 by P0 plus G. Next, simple average mean. Sigma x equal to sigma x by n. X bar equal to sigma x by n. This sigma is an aggregate of all the returns divided by number of data you have taken. Standard deviation, simple average. Sigma x equal to root of sigma x minus x bar the whole square divided by n. Next, mean weighted average, x bar equal to sigma p into x, probability into x. Standard deviation, sigma x equal to root of sigma p into x minus x bar the whole square. Okay, divided by n will not come because already we have taken probability. Okay, this sigma is not for probability. Probability sigma is 1 sigma of this entire data. Next, variance. Variance means nothing but standard deviation without a square. Remove the square, it becomes that. With the weighted average means divided by n also will not come. Probability will come sigma p into x minus x bar the whole square. Risk with the two securities. Root of wx square sigma x square. Wy square sigma y square plus 2wx wy sigma x sigma y rxy. If rxy other than, if correlation is other than +1, 0 and -1. If it is +1, simple formula. Wx sigma x plus wy sigma y. It's called a standard deviation. Sorry, this is called a weighted average risk. Next, if correlation is -1, same a minus b. That's it. Okay. Over. Next, when correlation is 0, root of that entire third component becomes 0. No? Wx square sigma x square wy square sigma y square. Next, very important. I wanted to reduce risk of the portfolio to 0 level. Okay, provided correlation is -1, then proportion of x is sigma y by sigma x plus sigma y. Sigma y by sigma x plus sigma y. Py is 1 minus px. Next, return of a portfolio x and y. Wx rx, wy ry. Rx means return of x, return of y. Covariance. Covariance, simple average na sigma x minus x bar into y minus y bar whole divided by n. If it is a weighted average na sigma p into x minus x bar into y minus y bar. Okay, as it is, you should follow this. Correlation is R means correlation of xy equal to covariance of xy divided by sigma x into sigma y. Sigma x into sigma y. So therefore Rxy can be written as, here final formula Rxy will be there na? Instead of that I can write covariance of xy divided by sigma x sigma y. Sigma x sigma y, sigma x sigma y cancel. So risk of two securities can be written as w x plus sigma x square, w y plus sigma y square plus 2 w x w y sigma x sigma y Rxy, like that you can write, or 2 w x w y directly covariance of xy. This also you can do. Next, if portfolio correlation is -1, then risk can be reduced to 0 by injecting in a proportion px equal to sigma y by sigma x plus sigma y. If it is other than -1, this formula, variance of y minus covariance of xy whole divided by variance of x plus variance of y minus 2 covariance of xy. Remember the formula, you have no option. Remember, this is not regular class portfolio. I have taken 52 hours. I can't do all those things now in 5-10 minutes. So formula you observe clearly. So variance of y minus covariance of xy divided by variance of x plus variance of y minus 2 covariance of xy. Next, capital allocation line, these are not important. I am not going to touch that now. Directly CAPM, RF plus beta into RM minus RF. Okay, beta can be calculated as delta SR by delta MR. Sir, when I should use the formula? If there is a constant slope or only 2 data is given in the question. Means year 1, year 2, only 2 data is available. So 2 points only will come. 2 points always form a straight line. Na? Hey, if 3 points are there, all are in straight line will come. If there is a points are scattered, na, curve will come. Only 2 points are there. Year 1, year 2 data. Year 1, year 2, year 1, year 2. Wherever you keep, it forms a straight line. That's why whenever there is a automatically formed straight line of a data given in the question, then this formula. That's why this is a constant slope. Slope should be constant. Next, other cases, beta equal to sigma s by sigma m into RSM. Okay, standard deviation of s by standard deviation of market. Okay, RSM. Beta using covariance of SM divided by sigma n square. Beta of a portfolio. Normally, beta means we calculate a portfolio means weight into multiply. Weight, how much you proportion of amount is invested. WX beta x, WY beta y, WZ beta z, like that. N number of permutations you have to do. Next, security market line equation, very important. Exam questions came in this equilibrium case. Y equal to mx plus c formula is there na? Same. Ke is the y. M means the slope beta. X is a constant. Okay, x is the constant return from the market. X is a intercept. I'm very sorry. X is a intercept, that is called as RP. RF is C, constant RF. So mx plus c, m beta, x RP, c RF. Security market line. Why? This is a straight line equation. Okay. In any question, KE they will ask you. RP they will give you. RF they will give you. RP means nothing but it is a RM minus RF. Yeah. Okay. Na? RM minus RF. Beta into RM minus RF. Na? So that's called as an RP. Risk premium. Okay. Risk premium. RM for entire market, entire India. For me, one RM, for you, another RM will not be there. Entire India, one RM will be there. Entire India, one RF will be taking. So RM minus RF, RP is same for everyone, na? Intercept. This is constant for everyone. Beta of security, if you can give me, I can calculate KE just like that. Okay. If expected return is more than required return. Expected return, how to calculate ER, how to calculate RR? Expected return is calculated in normal formula. Okay, KE equal to D1 by P0 plus G. Like that they will calculate. RR means they will calculate using RF plus beta into R minus RF. Simply CAPM KE and KE as per the dividends, KE equal to D1 by P0. Compare both of them. If ER is greater than RR, underpriced, buy. If ER equal to RR, correctly placed, hold. ER less than RR, overpriced, sell. Most important, levered and unlevered beta. This attempt question can come. Levered, unlevered beta. Logics aside, formula. Without taxes. I will directly tell with the taxes, sir. Without taxes, sir, remove that. With the taxes. Beta unlevered equal to beta levered into E by D into 1 minus T plus E. D into 1 minus T plus E. Beta levered is beta unlevered into D into 1 minus T plus E whole divided by E. Formula you have to remember. Logic, everything you know. 1.5 to 2 hours we spent on this. Regular and EOB batch both. Okay. I can't do that now. I'm very sorry. But try to understand. Next. Arbitrage pricing theory. Same. RF plus beta into R minus RFA. In a different way. Instead of taking one factor, they will take multiple factors. K equal to RF. RFA called as a lambda 0 plus RM minus RF we will take na beta into RM minus RF. Beta into RM minus RF delta, lambda 1. Okay. Lambda means a risk premium. That's why see lambda is a risk premium, RM minus RF. Beta is a beta. So this is how we will calculate. Okay. One question is also there in my book. We have done that question. So please go and do that question on this. Risk premium can also be taken as actual value minus expected value. Next, beta, advanced level calculation of beta. Okay, covariance, reduced formula. Sigma data is given year 1, year 2 security data they will give X, Y, or market and security data. Market is always X, security is always Y. Remember, market is always X, Y, market is in X axis. Market influences security. Influencer should be on X axis, influencer should be on Y axis. X minus X bar into Y minus Y bar whole divided by sigma X minus X bar whole square. Like this, you can do beta calculation without correlation. So you need not calculate, even covariance also not properly required. X minus X bar, Y minus Y bar. That's it. Answer completed. Beta you can calculate just in a minute. Regression equation. Sigma xy minus n x bar y bar whole divided by sigma x square minus n x bar the whole square. This is regression equation. Type 1. No, sir. Another type is there. Yes. N sigma xy minus sigma x sigma y whole divided by n sigma x square minus sigma x the whole square. This is x bar square. This is sigma x square. X means what? Market return. Take all the market returns. Market return is 10%, 12%, 15%. Okay. 10%, 12%, 15%. Totally some percent will come now. That into square. That square. Sigma x square. Not x square ki sigma. Sigma x ki square. This is x square ki sigma. This is x square sigma. Market return square. Total them. That total. This is sigma x square. Clear? X square sigma is different. Sigma x square is different. This is x square sigma. This is sigma x square. Formula very, very important. You write somewhere, remember that. Mug up literally. This is not the time to learn anything. If you don't know before, if you are already my student, 1000% you will know this. If not, also you will know definitely. If anyone listening to this don't know, mug up literally. You don't have time now. Because anyone listening to this video, I hope that you are writing exam in another one and a half week. So sigma xy minus n x bar whole y bar divided by sigma x square minus n x bar the whole square. N sigma xy minus sigma x sigma y whole divided by n sigma x square minus sigma x whole square. That's it. These are all some main formula that you need to remember. Okay. So with this, we completed so many things. I will come with another short video on the most expected formulas for this exam in the sharp single index model, and some other formulas also I will keep and I will put. Okay. Listen to the video properly. If you have any doubts, put the comments, and I ask you, please like this video such that it will recommend to more number of students. Okay. They will also get benefited. Thank you.